5 alternatives to bank financing for commercial businesses. While traditional bank loans have long been the gold standard for commercial funding, the ever-evolving financial landscape has popularized several alternative avenues. These options provide much-needed flexibility for small and medium-sized enterprises that may not meet the rigid 5 C's of credit required by major financial institutions. However, moving away from conventional banking often introduces unique structural risks that can impact a company's long-term health. Understanding the trade-offs between speed, cost, and control is essential for any business leader seeking to diversify their capital stack. Asset-based lending is a prominent alternative that allows businesses to secure capital against their accounts receivable, inventory, or equipment, rather than relying solely on credit scores. This model is particularly effective for companies with significant physical assets but inconsistent cash flows, as it focuses on the liquidation value of the collateral. The primary risk associated with this method is asset seizure, where a temporary downturn in business could result in the lender taking possession of the very tools or products needed to generate revenue. Furthermore, if the market value of the pledged assets drops significantly, the business may find itself in an underwater position, owing more than the collateral is worth. Lenders may also impose strict reporting requirements and audits to ensure the assets remain in good condition, adding an administrative burden to the business. Revenue-based financing offers a non-dilutive way to raise funds by promising a fixed percentage of future gross revenues to investors until a predetermined multiple is repaid. This model is highly attractive for software-as-a-service companies or digital brands with high margins, as it avoids the loss of equity associated with venture capital. However, the variable nature of the repayments introduces a cash flow squeeze risk, especially during periods of unexpected operational expenses. If a business experiences a surge in revenue, it may end up paying back the capital much faster and at a much higher effective interest rate than anticipated. Conversely, if growth stalls, the continued diversion of a percentage of every dollar earned can make it difficult for the company to cover its basic overhead costs or pivot its strategy. Peer-to-peer lending platforms have democratized access to capital by connecting businesses directly with individual or institutional investors through digital marketplaces. These platforms often provide much faster approval times and more flexible terms than a local bank branch, making them ideal for urgent working capital needs. The inherent risk in this model lies in the repayment volatility and the lack of a personal relationship with the lender. If a business faces a crisis, there is rarely a dedicated loan officer to negotiate with. Additionally, because these platforms are often unregulated or lightly regulated compared to banks, the interest rates can be significantly higher to compensate for the increased risk of default. Businesses must also be wary of the impact on their credit profile, as multiple inquiries from different alternative lenders can inadvertently lower their overall credit worthiness. Mezzanine financing acts as a hybrid between debt and equity, often used by established firms for expansions or acquisitions where traditional debt limits have been reached. It provides a massive injection of capital without requiring immediate collateral, but it is subordinated to other senior debt, meaning mezzanine lenders are the last to be paid in a liquidation. To offset this high risk, lenders charge exceptionally high interest rates, often ranging from 20 to 30%, which can quickly erode the company's bottom line. The most significant risk, however, is the equity kicker, which grants the lender the right to convert the debt into ownership if the loan is not repaid in full. This can lead to a surprise dilution of the original founder's shares and a loss of board-level control at a critical juncture in the company's growth. Equipment leasing is a tactical alternative that allows a business to use high-tech machinery or vehicles for a fixed monthly fee without the upfront cost of a purchase. This pay-as-you-go approach helps preserve cash for other operational needs and provides a built-in hedge against technological obsolescence. The downside is the cost of non-ownership, as the total sum of lease payments often far exceeds the actual purchase price of the equipment over time. There is also the risk of restrictive covenants in the lease agreement, which might limit how the equipment is used or require expensive maintenance from specific providers. At the end of the term, the business may be forced into a costly balloon payment to buy the asset or face a logistical nightmare in returning it and replacing it with new equipment. In conclusion, while these 5 alternatives offer vital lifelines to businesses excluded from traditional banking, they are not without their perils. Choosing the right path requires a meticulous analysis of the business's current asset base, projected revenue stability, and the founder's willingness to share future profits. By carefully weighing the speed of access against the potential for high interest or loss of control, an enterprise can build a resilient financial foundation. Ultimately, the most successful firms are those that use alternative financing as a strategic tool for growth rather than a desperate measure for survival. To learn more about our law firm's corporate business legal practice, we welcome you to visit our website and contact our law firm to schedule an initial consultation. Thank you.